to ask questions if you have questions along the way. But I'm just going to go ahead and kind of present the financials. We'll look at a balance sheet. We'll look at your income statement by source. We'll be able to see it by sewer and by water. And then we're going to have a brief look at our statement of cash flows, which is where we're going to kind of understand the total inflows and outflows of our cash. So the first sheet that Jesse has up here is the balance sheet as of April 30th, 2022. What you're going to see on the top here is the totals of our checking accounts. Go ahead and scroll down, Jesse, if you wouldn't mind. The checking accounts all have shadow accounts tied to them, but for the presentation purposes, we've been able to consolidate them for easy reading. Jesse and Clint are taking care of the monthly reconciliations on those, and those are completed at the time of the financial statement presentation. So accounts receivable, our 1200 accounts receivable account. This is an account that we have that includes basically any receivable that is not tied to our billing, that's not tied to the user fees. An example would be if there's a receivable in there for a reimbursement from the DEQ, or if there's any other special invoicing that's not tied to the monthly user fees. The other current assets account, I'm just going to run through those so that you can kind of have an understanding of what they're for. The 1205 account, that's our billing accounts receivable. So that is an amount that we show as of the end of April that are outstanding receivable for the user fees, both sewer and water. The 1206 account, tax roll receivable, this is an annual, historically has been an annual adjustment for the audit. These are the amounts that have been sent out to the two separate counties for collection. That's the receivable amount that we had posted as of the end of the fiscal year. Discussion can be had around whether we want to make that a more frequent adjustment. I did go back historically and look at where those amounts were at fiscal year ends for several years. And there is some movement back and forth. Nothing largely material, which leads me to believe that an annual adjustment there is probably sufficient. However, as we get more familiar with this balance sheet, if that's a need that we want to see, we can surely look at doing that more frequently than annual. Same thing with the interest and prepaid insurance, and so on. So I'm going to point out that the 9001.
That's that reimbursement 6 that spans over the fiscal years that we decided today that we were going to go ahead and do. So that would be the only one left unaddressed.
Yeah, okay, perfect. The SRF loan reimbursement expense, this is one that is going to eventually just be gone, the 9001 account, because we redirected the way that our accounting hits that particular account. And I'm going to show you here in a minute what we're talking about. Jesse, you can go ahead and scroll down.
Yeah, that one is the only one that is left hanging out for us because it does span those couple of fiscal years. Those are the water maintenance ones that we've all been working so tirelessly on.
So did we get the 61.4 or 64.1? The other one, we had two invoices. One was for a little over 64,000, and then this one, 2 outlay reports.
Yeah, those are with them. I've actually been working with DEQ today on those.
Yep. But we haven't received.
We have not received them. It doesn't look like they've even cracked it open until today. So
I guess we hadn't.
They're submitted.
Their one until May. That's why.
Yep, that was May 6th. We submitted them, and then so they just cracked it open today.
Yeah, so we do have.
Yeah.
Okay.
Where would you like me to scroll down?
Oh, right there. You're good. The next thing that we're going to talk real quick over is you can scroll back up a little bit. Sorry, we're talking about fixed asset.
No problem.
So our fixed asset posting. The main account that we're concerned with, that we're working with right now, is that 1804 account. It's that construction in progress account. The construction in progress account is tied to the improvements that we're making. These are the DEQ improvements on the water side. And as we accumulate expenses from our vendors for that project, this is the account where we place those. And the reason that we place them in the construction in progress is we can't actually take them to a hard asset account like a particular, like let's just say Cape Horn Water System. We can't take them to a particular asset account, fixed asset account, until the project is placed in service. So the construction in progress is our holding account. That's going to continue to grow as we incur more and more bills that are tied to the DEQ. Okay, so go ahead.
So can, there's over $418,000 in there now.
Mm-hmm.
Is this all reimbursable?
Yes.
So that is a combination of all of your outlay.
The balance, the balance, Colleen, that will remain in the construction and progress account will all be reimbursable. Let's go ahead and scroll down here, and we'll come back to that, Colleen, because I want to point something out to you here in a minute.
Yeah, and I have something on that one too.
Yep.
Okay. Because that number is going to change a little.
Yep. Our 1910, 1920, 1930, these are, again, there's an annual posting to tie out to the audit, but essentially these are the receivables left on those two LIDs. You can see that water still has more coming in. The sewer is almost used up.
Yeah.
We can continue to scroll down. The 2000 accounts payable account, these are all of the accrued expenses that Jesse and Clint have received to this point that were associated with the previous period. So they've accrued $59,000 of payables as of the end of April. And so we want that reflected on the balance sheet. The other current liabilities are accrued payroll liabilities. These are annual adjustments. The reason that we determined that annual would be sufficient is because we aren't adding or subtracting large amounts of payroll. The change on a monthly basis would be non-material. And so we're going to just go ahead and hold to the pattern of the annual adjustment to those accounts. And you can expect that to be fairly accurate in terms of what's accrued for the period. The deferred revenue, these are prepaids. Again, this is an annual adjustment that we determine for what has been prepaid in amounts. It's really a balance sheet / an audit item. All right, we can continue to scroll down. This is where we're going to see our the DEQ loan, right? So there's the DEQ loan amount is, in theory, the amount that we have submitted for reimbursement, and we've gotten reimbursement, and now it's become a loan payable. Okay, I know the loan is not due currently, but that's where we're going to see the increase of the loan amount, and we'll tie that out to the monthly statement that we get to the DEQ loan. So I want to point something out here. That DEQ loan amount has a connection with the construction in progress amount. Okay, the two are the DEQ loan amount is theoretically always going to be chasing that construction in progress amount, and the reason being is as you are recording expenses to be reimbursed, that construction in progress account is going to be growing. Once you receive the reimbursement, the DEQ loan amount then grows. That makes sense. So it's going to be this constant cycle of we're incurring expenses, reimbursable expenses. Jesse sends off a reimbursement request to the IDEQ, then they pay us back, the loan grows. And so that's kind of the cycle that we're going with. There will be a few more slight adjustments to the CIP and DEQ loan account because there are a few reimbursements that are out there right now. And so come May report, you'll see a different amount for obviously both of those.
I do have one question on that, is where is the write-down?
The forgivable portion,
Yes,
yeah, it's posted as part of that. Is that something that you would like us to see separately, Colleen?
yeah, yes, absolutely.
Okay, we can add that as an account.
It'll be easier for you, Jesse, when it comes in.
Okay, so we will get that on for the next presentation to have that separated out. The other note that I wanted to point out here was our equity portion. You know, the retained earnings. These are annual postings that get, or annual closeouts that are determined largely by the audit. We will be making an adjustment to how these read. It will not impact the amount, but it will impact the way that the accounts read. And the reason that we decided that we wanted to do that and talk with Colleen is because the audit displays this a little bit differently. They have a different grouping schedule. In other words, what makes up our net investments is represented slightly differently on the audit. So as soon as Scott is done with the audit and we have the year-end numbers confirmed for the previous fiscal year, I will go in and make the adjustment. It didn't make sense for me to do it now while he was doing the audit because I didn't want that to trigger any kind of confusion for him.
But I do have one other question then in the equity section. What is that restricted for debt service?
Yeah, and you know, that's tied to the audit, Colleen, and the way that Scott has to present it, I'm imagining without pulling that back up, that typically, those are typically amounts that you have dedicated, or they call restricted, to paying off debt. So I'm imagining that this amount is probably going to shift once Scott has the audit done. Yep.
Yeah, because we paid off that other loan and we haven't made any restricted debt service on this new one yet. So I'm sure it'll change. Okay.
And then Sean, you and I also talked about possibly rewriting those accounts to better match the audit titles, so that that's
so that's what I was referring to. Once the audit's settled, I'm imagining, Colleen, that 3400 account will be significantly different, and then we will create the accounts to tie up specifically to how the audit reads. That way, there's no question for interpretation against the two.
Yeah, that's good.
I might have replicated.
So I feel really good about the balance sheet. The areas that the board can, that we can continue to work on are things like what Colleen said about wanting to show the write-down portion separately. I understand that makes sense. One of the other things that we had discussed with Jesse was the assessment portion, wanting to maybe show that a little bit differently. So we will wanting to pull that out. So we're gonna discuss that. And so I really think that this is a great foundation. I feel good with the numbers. We'll continue to work on improving it as the board sees fit, as well as having a plan forward. Jesse and I to do our monthly reviews and just make sure that things are lining out how they are supposed to. So there's quite a bit of work that went into this. I feel like we've been able to streamline a lot of the processes so that they're hitting this balance sheet account naturally. This should reduce time for pre-audit next year. And so I feel good about that. Is there any other questions on the balance sheet?
Does anybody have any questions? Well, I think we're good to see it simplified.
Yeah.